Is it too late to invest in Sydney? If you are going to invest in Sydney, 6 things you need to know, and the secret to living longer. That's what we're going to discuss this week.
Are you interested in property investing, success or money? Well, you're in the right place. This is the Michael Yardney podcast, where each week you'll learn a number of new ideas regarding success, property investment and money in 20 minutes or less. Our show is brought to you by Metropole, who specialise in helping you grow, protect and pass on your wealth through strategic property advice. Now here's your host, Michael Yardney, who has once again been voted Australia's leading property investment advisor. That's the 4th time he's won a similar award in the last 6 years.
Welcome to this week's podcast. If you're a new listener, thank you for joining us. If you're a return listener, thank you so much for your support. I'm having a lot of fun putting these podcasts together, but I'm getting great joy seeing them rank in the top 10 business podcasts in Australia on a regular basis. Today, we're going to spend a bit of time talking about the Sydney property market, but even if you're not interested in Sydney, there's some great lessons here for you. You see, many investors want to know what's happening in Sydney, which is obviously Australia's largest property market, because clearly price growth has stalled, auction clearance rates have dropped. So the question on many people's lips is, do I buy now? Don't I? Should I wait for prices to fall? Should I get in? Should I get out? Well, today we're going to discuss what's really going on in Sydney with Ahmed Imam, Senior Property Strategist of Metropole in Sydney. And as I said, even if you're not interested in the Sydney market, there are some valuable lessons in this show for you as Ahmed explains what investors really need to know about investing in Sydney. So if you're looking at a different market, you can adapt this type of thinking to your local market. As I see it, Sydney's transitioning at the moment. It's moving from its booming conditions into more normal conditions, but this period of change is bringing uncertainty out. In turn, this brings in action from buyers who are waiting to see how things pan out. But it also creates great opportunities for those who are willing to take considered action. So we're going to discuss that in just a moment. And in my mindset moment, I'm going to share with you the secret to living longer. And that's been shown by research, and it's probably not what you think. So it's definitely going to be worth listening to the show just for that alone. But first, let's start our 2-part discussion on what's happening in the Sydney property market as I introduce my guest, Ahmed Imam, Senior Property Strategist from Metropole in Sydney.
Hi, Michael. Pleasure to be here.
Now, Ahmed, I bet you it's a question you're getting all the time. What's going on in Sydney and am I too late?
It's a question I receive on a daily basis, Michael. Look, for some, hearing the word Sydney and property in the same sentence is actually making them cringe. For others, they see dollar signs and opportunity, and it really depends on their personal experience and their personal experience with property in Sydney. Whether or not you're an amateur investor or an experienced investor also plays a big part, because if you're an experienced investor, you've seen this all before. You know, let's face it, we receive so much conflicting information on a daily basis from so many different sources. At the end of the day, you really don't know if you're Arthur or Martha. I believe it was Mark Twain that actually said that if you don't read the newspaper, you're uninformed. And if you do read the newspaper, you're misinformed. So it almost seems like we can't win.
I think you're right there, Ahmed. It is interesting with all the white noise and all these commentators, because they say the Sydney market is doing this or the Sydney market's doing that. And it's actually not, because there isn't a Sydney property market. So clearly certain sectors are performing a bit stronger than others.
Yes, Michael, absolutely. Look, there's many different markets within Sydney, and it's all based on price, geography, demographics, of course. And so the market is definitely fragmented, and it's all about making sure you're picking the right criteria to select the right market.
Interestingly, it's a bit like putting my right hand in a bucket of cold water and my left hand in a bucket of warm water and saying, on average, it feels reasonably cool. But there are some parts of the market that are still pretty strong. And obviously, there's some markets that are cooling off a little bit, particularly the outer suburban market and also the top end of the market where people are a little bit worried about taking on more debt and upsizes. So if people are now interested in getting involved in the Sydney property market and they can't expect every property to perform well. By the way, they never could anyway. But what hints would you give if I said to you, Ahmed, Tell me 5, 6 things an investor needs to know before they get involved in the Sydney property market. What would they be?
I think it's important to be very transparent. And so there are a few things that we do need to be aware of. The first thing is the entry-level price for an A-grade asset. When investing in Sydney, you must be prepared to pay a higher entry-level price than, say, you would in Melbourne or Queensland. The entry level for an investment-grade property in Sydney is $600,000 and climbing at the moment, and that's compared to an entry level of $400K in Melbourne or $350K in Brisbane. And that's a difference of $200,000 in this current climate of affordability constraints and tighter lending conditions.
Sure, but if you invested in any international city on a coast with water all around it, that's not unusual, is it?
No, of course not. So it's all about managing the expectations.
So it's an international city, and you're getting that with the large population growth, the strong economic base, the infrastructure spending. So yes, to invest in any big international style city, you have to have a higher entry level. So just on that then, any other thoughts if somebody's considering the entry level in Sydney?
Yeah, look, I think it's important to keep in mind that, of course, you can buy properties for less than $600,000. I'm not questioning that, but whether or not it would be an investment-grade asset is the question. Do not assume that an A-grade asset in Sydney has to be a big house in the eastern suburbs on a big plot of land. An A-grade asset is simply an asset that is both strong and stable. We've spoken about this before. Strong in that it has wealth-building rates of growth, and stable in that it's in locations that doesn't fluctuate in value. Now, managing expectations is key here. Don't be afraid to buy an apartment in Sydney, if that's what your budget allows, as long as, of course, it ticks all the boxes.
I guess it's much the same, Ahmed, as if you invested in New York or in London. You wouldn't expect to buy a house, would you? So Sydney has Manhattanized. People are living differently to 10, 15 years ago. I guess if you're an international visitor coming to Sydney, haven't been back for 20 years, you just wouldn't recognise how our style of living has changed.
Absolutely right. And look, just like in Manhattan, you can't expect to purchase a big house on a big block in the right location within your budget. It just would not happen. This is an investment after all, so you have to take emotion out of it.
So the first point you're making for investors to understand is the entry level in Sydney is higher. What other important factor does a potential investor have to know about the Sydney property market?
The other thing is, don't just look at rental returns. And in my experience, most amateur investors look at two criteria when investing in Sydney. They look at the price and they look at the rental return. Obviously they're concerned about cash flow. And yes, both are important criteria, and you definitely need to secure the asset at the right price. But one crucial factor that amateur investors neglect is the average annual growth of the investment. That is the capital growth. The reality is that there's two philosophies for investing. You can invest for cash flow, as in your rental return, or you can invest for capital growth. And one must be compromised. Ideally, it would be great to have both, but you can't have your cake and eat it too, unfortunately.
Well, interestingly, I agree with the concept you're saying, but we have found a way for our clients to virtually get there because you can't change the location of the property. So a low-growth property will never become a high-growth property, but a high-growth, reasonably low-yield property can end up having a higher yield if you can improve it, if you can do some renovations, some refurbishment to make it more attractive to a wider range of tenants and therefore increase the return.
Yeah, correct. And look, I think development is probably the only exception to that rule. I'm not going to go into a debate about capital growth versus positive cash flow. However, it's fair to say that the further away you go from the CBD, the more likely you're going to find a property with above average yield, and you'll compromise on capital growth. And the opposite applies when you invest within the inner middle rings of Sydney. You're more likely to find a property that has above average annual growth, but you'll likely compromise on the yields. And look, Michael, the yields that we see in Sydney for the properties that we purchase at least are around the 3 to 3.77%. They're not low, but they're not high. However, the growth that we receive on these properties outperforms the averages in growth of 7.5% in the long term. And that's what we're looking at, a long-term strategy.
So interestingly, at this point, when people are thinking, but there's not going to be as much capital growth in Sydney, maybe I should go for rental returns. In my mind, they're taking a short-term philosophy rather than a long-term picture where they're going to compromise, and I don't think it's the right time to buy a secondary property.
Yeah, absolutely. If you have a long-term investment strategy, then my suggestion is do your research, pull out the calculator and do your numbers. calculate the projected growth and value of an A-grade asset over a 10 to 20-year period and compare that to the growth and value of a secondary or B-grade asset with minimal growth over the same period. You really can't argue with the numbers.
So, point 2 is don't just look at rental returns, because you get your investment returns in 4 ways: capital growth, rental yields, manufactured capital growth, which is doing renovations and redevelopment, and the 4th way, of course, is through tax benefits and depreciation benefits. But in my mind, if you've got to choose any of those, the most important one, of course, is capital growth, because that's going to make the big difference in the long term. When you think about it in 10, 15 years' time, when you plan to retire in your property portfolio, the vast majority of your asset base isn't going to be the rent you get. It's not going to be the depreciation allowances you've had. It's not going to be the little bit you add value through renovations. It's going to be the long-term appreciation, which is tax-free of your investment. So that's got to come number 1 in your selection criteria.
Yeah,
right.
Absolutely.
So the third point you'd like to make to investors before they consider getting involved in Sydney?
The third thing is, and this is especially critical for the current times, and that is, do not expect the same level of growth that we saw over the last 4 to 5 years. And I know we've touched on this previously, but the last 4 to 5 years in Sydney has seen unrealistic levels of growth. Growth well into the double digits in most cases. It's given investors, especially amateur investors, a false sense of confidence. The growth has been so strong that even the secondary assets in those secondary locations have seen growth over the past few years. And now that the Sydney market is taking a well-deserved breather, we just can't expect those levels of growth going forward.
Interestingly, one of the worst things that can happen to a beginning investor is get it right first time, because you think you're smart. And so I think a lot of people who've got involved in the Sydney property market have been carried by the rising tide. But interestingly, as Warren Buffett said, when the tide goes out, you see who's swimming naked. And those who bought secondary properties in poorer locations like on main roads or in some of the outer suburbs are already starting to see the value of their properties just wobble a little bit. So your point really is, I'm sorry to interrupt your train of thought, that you can't expect the same capital level of capital growth. But as you say, that was unsustainable. And if it does keep going, if it did keep going, what it would have done is mean we would have had a bigger crash. And I'm comfortable that APRA and the Reserve Bank are doing the right things at the moment, because I'm much happier investing in a more stable, less volatile property cycle where the highs aren't as high and the lows aren't as low. It's much easier to invest in these times. And the fact that the market slowed a bit doesn't worry me personally that much, because it means there are more opportunities with less competition.
And look, you're absolutely right. Some of these changes are going to become even more apparent over the coming months. The secondary assets start to suffer, and those who invested in the secondary assets start to struggle. You're going to see rises in interest rates. There is tighter lending conditions as we see them at the moment. Investors being previously on interest-only loans are now being forced into principal and interest structures. It's starting to put a lot more pressure on that socio-economic demographic.
That's great. We've gone through 3 things potential Sydney property investors need to understand, apart from the fact that it's not too late. One is about the entry level of prices, a little bit higher than you'd expect, not to just look at returns and not to expect the same levels of capital growth. We're going to take a short break in the Michael Yardney podcast, Ahmed, and I'd like you to come back with 3 more tips for potential Sydney investors. Would that be okay?
Absolutely.
If you're looking to get started in property or to grow your existing portfolio, turn to someone you can trust for independent advice. The team at Metropole Property Strategists have been involved in over $2 billion worth of property transactions, creating wealth for their clients, and they can do the same for you. They don't sell property, so their advice is independent and unbiased. Metropole can devise a strategy, their buyer's agents will buy your property for you, or you could use their renovations team, property development or portfolio management services. Arrange a time for an obligation-free chat at metropole.com.au. Now here's Michael's mindset message. Remember, a change in your thinking will lead to a change in your life.
My mindset message this week is a bit different. It's going to tell you the number 1 way to live longer. Now, who doesn't want to live longer? I mean, that's one of the reasons we eat healthier, go to the gym, quit smoking. Now, I actually missed the gym this morning. I think that's about 5 years in a row now. But if you want to live a happy, healthier life, it turns out there is an incredible amount of scientific evidence that points to one simple answer. But before I tell you what that answer is, I'm going to tell you some of the things that aren't the number one answer, but probably things that will still reduce your chance of dying the most. And one of them is cutting down smoking less than 15 cigarettes a day, or quitting smoking altogether. Of course, that's even better. Giving up heavy drinking, getting a flu vaccine is one of the ways of preventing dying sooner. Doing exercise, being lean versus being overweight, treating your hypertension, all these things do lead to a healthier, longer life. But the study shows that the number one factor in having a long, happy life is relationships. These are 3 times as powerful as exercise. Now, by the way, online relationships don't count. Now, look, there's no surprise there. You can have tons of online friends and still feel lonely. Being part of a community makes a big difference, and work relationships count as well. So there you have it. The number one way to live longer is having good, healthy relationships. So what's the message from this? Stop staring at your smartphone and listening to me. Go out and hug somebody. Well, earlier in the podcast, Ahmed Imam, Senior Property Strategist at Metropolitan Sydney, was telling us a bit about what to look out for if you're planning to invest in Sydney, including the fact that it's really not too late to invest in Sydney. So, Ahmed, let's continue with the conversation. And one of the things that people from other states would consider is that, hey, look, there's the Sydney CBD, but I've also read about Parramatta and Chatswood and Penrith and Hurstville. Are there lots of different CBDs, and can I just invest close to those rather than the Sydney area, because I can't afford the Sydney area?
Yeah, it's something I hear quite often, and it really comes down to affordability. The clients say they want to invest in those secondary CBDs because that's where they can afford to buy. And my response to that is affordability is not an investment strategy. You don't make a decision on investment purely because you can afford it. The reality is, Michael, there's only one CBD in Sydney, and every other CBD is secondary to that main centre. And yes, Sydney is decentralising. There's very clear consensus that Parramatta is being built as Sydney's second CBD. Like you mentioned, it's followed by other large centres like Chatswood and Penrith and Hurstville and Liverpool, to name a few. But they're not going to experience the same levels of long-term growth as the inner middle ring suburbs of our main centre. And if you wish to take a calculated risk, then you need to avoid the hot spotting and speculation that's involved in attempting to go into those secondary areas. Stick to the pockets that only have the growth drivers that have shown evidence of long-term growth and stability. That's the key.
I understand what you're saying, because if we take a look at other large international cities around the world and see how their property markets have performed, it's much the same. So we're not saying that there won't be growth in those other areas. There clearly will be. But if you're wanting to outperform the averages, and I guess that's what our strategy is, I know yours personally, mine isn't, what we try and impart in our clients, then if you want to outperform the averages, you've got to go where there's going to always be a level of scarcity and where the main bulk of the jobs are, and interestingly, the main bulk of the higher paying jobs. So when you started off talking about affordability, Sydney's unaffordable to some, but clearly it's not unaffordable to lots of other people, otherwise the prices wouldn't keep going up.
Yeah, that's right. It's all about optimising your investments.
Now, clearly one of the challenges Sydney is going to have as it's grown, it's over 5 million people now, is its infrastructure and transport. And I guess if we take the leaf out of what's happened in international cities elsewhere, proximity to infrastructure, particularly public transport, is going to be important. How important is parking and car parking in Sydney?
Very important. Our Sydney listeners would understand that we spend most of our time behind the steering wheel. I mean, there's absolutely no doubt. A parking space is almost becoming non-negotiable.
It's interesting, yes, I wonder how many people are listening to this podcast at the moment in the traffic, stuck listening behind their steering wheel.
I don't doubt that at all. And yes, we've got higher density living and better public transport, as you say, and much better than we did say 20 years ago. But don't underestimate the impact of a parking space and the growth potential that it has on an asset. And you don't necessarily need a lock-up garage, but at the very least, try and seek a property with a parking space, in my opinion.
Sure, that'll always cost a bit more, but when the market's hot, as it's been in the last couple of years, properties without parking spaces have sold. But as the market flattens, whether it's the rental market with tenants looking for potential properties or owner-occupiers wanting to buy the property if you're planning to sell it, your property will always be worth more and attract a wider potential group of tenants and owner-occupiers if it's got car parking.
Yes.
Now, Ahmed, I fly into the Sydney office often, and the Sydney airport is interestingly very close to town, very, very different to Melbourne or even Brisbane, where there's or any of the other capital cities. How does that affect where you would invest? You want to be right near the airport because it's convenient?
Look, you want to be cautious of the flight path, as well as obviously how close the airport is to those suburbs surrounding the airport. Unlike Melbourne, where Tullamarine is 23 kilometres from the CBD, or Brisbane, where the airport is 15 kilometres from the CBD, the domestic and international airport of Sydney is only about 8 kilometres from the CBD. And it's also surrounded by residential suburbs. Hence why we have an airport curfew in Sydney, which, limits takeoffs and landings between 11 p.m. and 6 a.m. We, of course, want to stick to the same strategy, Michael, of buying an A-grade asset in the inner middle rings of Sydney Metro, but nobody wants a property directly under the flight path. So just make sure you do your due diligence, and no different from doing your due diligence on whether the property has the right aspect and whether it's getting the relevant sun. Make sure you're not being impacted by the noise pollution of being directly under the flight path. And I've got an interesting statistic. According to Sydney Airport, there are approximately 60,000 passenger aircraft movements per year, and that works out to be an average of 164 aircraft movements per day.
That's an amazing amount of 164 planes coming in and out, I guess in and out, so it's 80 flights a day. That's a lot.
It's huge. Like you said, our population has now exceeded 5 million. We are a global city. So given there's a curfew between 11 p.m. and 6 a.m. and flights are only operating for 17 hours per day, that averages out to be 9.6 aircraft movements per hour, or an aircraft movement every 6 minutes. Now, I don't know about you, Michael, but I don't want my dinner parties and barbecues and conversations being interrupted every 6 minutes. So it's just something to be conscious of.
Right. Well, you've given potential Sydney property investors quite a bit to think about. First of all, that there are still opportunities, but you've got to be more careful. And then you've given us 6 things to think about to prevent us making mistakes, especially if you're coming from another state and wanting to get into the big smoke of Sydney. Be careful about entry levels. Don't just look at returns. You're not going to get the same capital growth you got in previous years. You also talked a bit about being close to the CBD. Parking space is important, and watch out for the airports. Some great insights there, Ahmed. And if people want to find out more about your team, they can go to sydneybuyeragent.com.au, or of course the regular Metropole website at metropole.com.au. Thanks for your time and your great insights, Ahmed.
Thanks, Michael. Always a pleasure.
Well, there you have it. The secret to living longer, plus the secrets of the Sydney property market. If you're enjoying my show, please go back to the archives on either iTunes or Stitcher or the Michael Yardney podcast and listen to some of the old episodes where there's so much great information. I'm having fun presenting them to you, and I'm making sure that you're going to keep getting regular shows over the Christmas break, when Pam and I are going to be taking quite a long vacation, by pulling out some great shows from the archives, some interviews I've conducted with people and some interviews people have conducted with me, and you can look forward to a special summer series of podcasts over the break. By the way, if you listen to the old shows, you can always listen to them at 1.5 times speed. That's what I do with a lot of podcasts. You're still going to get lots of information out of them, but it just makes things a little bit easier. I look forward to catching up with you again next week for the Michael Yardney podcast.
Thanks for listening to this week's episode of the Michael Yardney podcast, which was brought to you by Metropole, who help their clients grow, protect and pass on their wealth through strategic property advice. If you got value from listening to this podcast, please leave us a review and we'll read it out on a future show. just go to michaelyardneypodcast.com/review and it will take you over to iTunes where you can enter a review and let us know what you think. We'd really appreciate it. If you don't already subscribe on iTunes or on your Android phone, you'll find us there as Michael Yardney Podcast. If you'd like to gain instant access to the show notes or a transcript of the show, head across to michaelyardneypodcast.com. Watch out for our show next week. You learn some new ideas about property investment, success, and money in around 20 minutes.